Hello, and welcome to Donatien Investment. This analysis is for CF Industries Holdings on the New York Stock Exchange as of 7th of August 2026 with a share price of $116. The full report is on donatien.ca. A hold on the tape now, a buy on weakness for the longer term. CF is cheap on mid-cycle earnings and structural nitrogen tightness is real, so we rate it buy over the medium and long term. But the post-earnings tape hasn't confirmed, so short-term we wait. Half size. Business quality scores 80 out of 100, the anchor of the longer-term buy. CF sits at the bottom of the global nitrogen cost curve because its plants run on cheap North American gas, while European and Asian rivals pay far more for the same feedstock. That structural edge means CF keeps generating cash even when fertilizer prices fall, and it steadily shrinks its share count with buybacks. The Blue Point low-carbon ammonia venture, online around 2029, is a free option on the energy transition. The trailing PE under 9 looks cheap, but that's on peak nitrogen spike earnings. FY 2026 is a cyclical high, not a run rate. We score CF on roughly $9 of mid-cycle earnings instead, giving a clean PE near 13 against a warranted multiple of 15. So the stock is fair and cheaper on any pullback. CF raised its mid-cycle EBITDA guide to about $2.9 billion on 5 August, which lifts the floor. Fair value sits at $124, roughly 6% above the current price. This is why we don't lead with a buy. The short-term picture only clears one of 3 entry gates, the fundamentals, while the technical and catalyst gates are unmet. After the Q2 print, the daily momentum has rolled over, volume is light, and there's no confirmed higher-low bounce yet. Our rule caps a short-term signal at hold until the tape confirms a bounce off around $114 with momentum turning up, or a reclaim of $121 on volume. Until then, patience. A half-size starter is the most we justify. The biggest risk is the one that makes CF cheap. It's a commodity producer near the top of its cycle. FY 2026 earnings ride a nitrogen price spike driven partly by the Hormuz disruption. CF flags this as a caution, not a red flag. A verified Iran-Hormuz ceasefire would collapse the supply premium fast. CF fell about 11% on the April reopening, and a wave of new Middle East and East Asian urea capacity is set to drag prices lower into 2027. Rising Henry Hub gas is a modest cost headwind. In the bear case, the stock falls to $95, about 19% below here. This is why the position is half size and short-term a hold. Now weigh the risk against the reward. The bull case is roughly 29% above today, the base case the most likely about 6%, and the bear case a fall of about 19%. So you are risking about 19 to make 29. So, our call on CF Industries Holdings, on the New York Stock Exchange, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Donatien Investment at donatien.ca. The link to the full report is in the notes below. Have a great day.